Of Americans say that they have more credit card debt than emergency savings. It's a little bit better than what we saw the last couple of years, but it's still notably higher than anything we had seen from about 2011 through 2020.
This week, the Federal Reserve expected to announce the first interest rate cut since 2020.
Credit card debt in America now exceeds $1.2 trillion, a figure that dwarfs many other national economic indicators.
Elizabeth, Americans' total credit card balances now stand at a record high $1.2 trillion. How significant is that number, and what else stood out to you from this report?
Yeah, and that's a big number, Diane. $1.2 trillion, that's up 7% compared to a year ago.
Major banks, including Visa, MasterCard, and American Express, profit immensely from a system built on interest rates often exceeding 20%, layered fees, and rewards programs that mask the true cost of borrowing. While other countries maintain more conservative spending habits, the United States relies heavily on credit, fueling an economy where many households struggle to keep up with soaring balances and mounting interest charges. Recent data from the Philadelphia Federal Reserve reveals that revolving credit card balances reached $645 billion in the third quarter of 2024, marking a 52.5% increase from the decade low of 2021. Total credit card balances have soared to a record $914 billion. At the same time, a concerning trend is evident. 10.75% of active credit card accounts are making only the minimum payment, a 12-year high. These statistics signal that while credit cards offer convenience and attractive rewards, they also trap consumers in a cycle of ever-growing debt. One of the most striking findings is that 1/3 of Americans now have more credit card debt than emergency savings, a significant jump from 22% just a few years ago. As cost of living rises and interest accumulates, many households face a stark choice: continue relying on credit or risk financial instability. Credit cards have evolved from simple payment tools to sophisticated financial instruments that influence every facet of our spending habits. Today, approximately 80% of U.S. adults own at least one credit card, with many carrying an average balance exceeding $5,000. This widespread use contrasts sharply with practices in countries like Germany or Japan, where cash and debit transactions remain dominant. In Germany, for example, recently published research by the Bundesbank shows that cash currently accounts for 51% of all transactions, reflecting a cultural aversion to debt that is less common in the United States. Banks and credit card companies leverage a powerful cocktail of incentives, including cashback, travel rewards, and exclusive perks, which create an illusion of free money. However, these rewards come at a steep cost. As stated by financial analysts,
you say a trap is chasing those credit card rewards. Explain why that might be a pitfall.
Well, there's kind of a thrill to getting free stuff, and I think that's why a lot of people love racking up those rewards points. Here's the thing, though. Rewards are only free if they're for things you were going to buy anyway, and if you can pay your balance off within the month.
The promise of tens of thousands of reward points or lucrative sign-up bonuses is designed to keep consumers engaged in spending, even if they eventually carry a balance. This system is not accidental. It is a carefully engineered method to maximize revenue through interest charges and fees, ensuring that every swipe contributes to billions in profit for the major financial institutions. A comparison with other nations illustrates the contrast clearly. In many European countries, strict consumer protection laws and a cultural emphasis on financial prudence have kept personal debt relatively low. In the United States, however, the aggressive marketing of credit cards, often combined with flexible credit limits, encourages consumers to borrow more than they can afford. The secret behind this credit card culture lies in both the design of the cards and the psychology of spending. Consumers are presented with convenience of deferred payment and the illusion of instant rewards. When you use a credit card, the immediate pain of parting with cash is separated from the actual outflow of money, making it easier to overspend. Research shows that people tend to spend 12 to 18% more when using a credit card compared to cash. This behavioral gap is the cornerstone of the credit card industry's success. Andrew Kish, assistant vice president in the financial monitoring group at the Philadelphia Fed, noted, "More borrowers are falling behind on their credit card payments. We'll be closely watching these performance measures in the coming quarters to monitor the health of consumers." His comment underscores the systemic risk posed by mounting credit card debt, particularly among lower and middle-income households. For many, the monthly minimum payment becomes a trap, prolonging debt repayment over decades. The system is further reinforced by the structure of interest and fees. While many consumers are attracted by rewards, the reality is that interest revenue far outpaces any benefits from cashback or travel points. According to TransUnion, the average credit card balance is approximately $6,380. With interest rates frequently above 20%, making only the minimum payment can leave consumers in debt for over 18 years, adding an extra $9,344 in interest alone. Consider the case of balance transfer offers. These promotions, often featuring 0% APR for an introductory period, provide a temporary reprieve from interest. However, they require disciplined repayment and are designed to encourage further borrowing once the promotional period ends. The contrasting models in other countries, such as in Australia, where consumers are provided with clearer warnings about debt risks, highlight the significant differences in how credit is managed internationally.
The financial regulator is planning a credit card crackdown to make sure consumers can afford to repay their debt within a reasonable period. It follows a watchdog review which shows almost 2 million people are struggling with their debt levels. A 3-year repayment rule has been proposed where lending assessments for the cards are based on whether the consumer can afford to repay the credit limit within 3 years.
The modern credit card is a product of decades of refinement by banks and payment networks. The early days of credit cards in the 1950s and 1980s were marked by straightforward lending practices. Over time, however, banks began employing more sophisticated strategies to boost profits. This shift led to the development of aggressive tactics like hidden fees, sudden interest rate hikes, and penalty charges designed to keep consumers paying interest for as long as possible. Despite regulatory reforms such as the Credit Card Accountability, Responsibility, and Disclosure Card Act of 2009, banks have adapted their models.
To provide relief from the abuses that have occurred in the credit card industry, particularly in the last several years. I've made this point over and over again, but we know just in the last 11-month period, some 70 million accounts in the country. 1 out of 4 families have had interest rates increased. Penalties have been increased. Fees have been added. In many cases, without any justification at all, not even where there have been delays or late payments occurring.
Instead of relying solely on punitive fees, they have pivoted to rewards programs that encourage consumers to maintain higher balances. These rewards are a double-edged sword. They offer immediate gratification but often result in long-term financial strain. Comparing the U.S. model with those in other markets reveals key differences. In the United Kingdom and Canada, strict regulations ensure that banks offer fairer terms to borrowers, including lower interest rates and structured repayment plans for those in debt. Conversely, U.S. banks like J.P. Morgan Chase, Citibank, and American Express have consistently reported record revenues from interest charges, highlighting a system that favors profits over consumer financial health. The political landscape further complicates the issue. Recently, Senators Josh Hawley and Bernie Sanders introduced a proposal to cap credit card interest rates at 10% for 5 years. This proposal, though contentious, represents growing public frustration with the current system, where high interest rates contribute significantly to personal debt burdens.
You've got debt like we've never seen before in American history. Your profit margins are as higher than they've ever been. You have 80% of the relevant market in the credit card interchange fees that we're talking about, and yet you couldn't survive if there's any competition? What am I missing?
On the flip side, banking trade groups argue that capping interest rates would limit consumer choices and force borrowers to turn to riskier alternatives such as payday loans. Ted Rossman, Bankrate's senior industry analyst for credit cards, warned,
a 10% cap would be really restrictive. The average credit card right now charges 20.13%. And I know that it sounds great if you're dealing with credit card debt. Wouldn't it be great to have a single-digit interest rate? The problem is that there would be major unintended consequences to this. I really believe that access to credit would dry up, rewards would vanish. This cap, in my view, is just too restrictive. Banks would point out that they couldn't be profitable if they could only lend at a maximum of 10% APR. Credit card debt is unsecured. Right now, the delinquency rate's at its highest point since 2011. The percentage only making minimum payments is at its highest point since 2012. It's not like a mortgage or a car loan that's secured by an underlying asset. Banks worry that people aren't going to pay them back, and that's why they charge higher rates.
This debate underscores a key conflict: the need to protect consumers while preserving a competitive market that fuels innovation and accessibility. The reward system itself is a powerful tool. Credit card issuers often offer sign-up bonuses that seem like a windfall, tens of thousands of points that can translate into free travel or cashback. However, these rewards come with strings attached. Banks control the creation and distribution of points and can devalue them at will. Moreover, many of these offers require significant spending before any rewards are earned, encouraging consumers to take on more debt. In addition to rewards, co-branded cards with major retailers like Amazon, Costco, and Kroger add another layer to the financial model. These partnerships usually involve banks paying retailers a cash bounty for each sign-up, creating a win-win scenario for both parties. However, the long-term cost to consumers remains high, as these cards often carry the highest interest rates in the industry. Mounting debt levels and minimum payment behaviors reveal a growing crisis for many Americans. Recent statistics show that credit card balances over 30 days past due have risen to 3.52% in the third quarter of 2024, more than double the 1.57% seen at the pandemic low in mid-2021. This upward trend indicates that an increasing number of households are struggling to keep up with their payments. For lower-income and middle-income consumers, the consequences are dire. Wells Fargo economists have highlighted that lower and middle-income household saving rates turned negative in early 2022, as these consumers drew down their rainy day funds. Although savings are slowly recovering, they remain below pre-pandemic levels. The burden is particularly heavy on millennials, and Gen Z Bankrate survey indicates that 42% of millennials have more credit card debt than emergency savings, while a significant share of Gen Z reports having no emergency savings at all. Real-world examples illustrate this stark reality. A survey conducted in December revealed that 73% of workers struggled to afford expenses beyond the basics, with about one-third taking on additional debt to cover their needs. For many, the monthly minimum payment is not a strategic choice but a necessity driven by financial hardship. This scenario is exacerbated by the fact that, on average, households with revolving credit card debt owe around $10,563, a figure that continues to rise as interest accumulates. The conflict between attractive rewards and the heavy cost of debt creates a painful irony. On one side, credit cards offer perks that promise luxury, travel, and convenience. On the other, they enforce a system where making only the minimum payment can lead to decades of indebtedness. TransUnion's data underscores this dilemma. Paying only the minimum on an average balance of $6,380 at an interest rate of 20.27% could leave a consumer in debt for 218 months, over 18 years, with an additional $9,344 paid in interest. The human cost of this debt is significant. Research has linked high levels of credit card debt to increased anxiety and depression. Financial stress can affect every aspect of life, from relationships to job performance. For many Americans, the cycle of borrowing and repayment is not just a financial issue. It's a source of daily emotional strain. In contrast, countries with more robust financial education and conservative borrowing practices experience fewer of these issues. For instance, Singapore enforces tighter lending regulations and promotes financial literacy through national initiatives. Although interest rates in Singapore are not universally capped, the Monetary Authority of Singapore, MAS, sets strict limits on unsecured credit and encourages responsible borrowing. As a result, the country maintains relatively low credit card delinquency rates compared to the United States. These differences underscore the need for enhanced consumer financial education and more balanced lending policies in the U.S. Despite the challenges, there are strategies and tools that can help consumers break free from the cycle of debt. Smart financial management begins with understanding the mechanics of the credit card system and taking proactive steps to counter its pitfalls. One effective strategy is to always pay more than the minimum payment. Experts consistently advise that this is the single most important step to reduce the overall interest burden. By reducing the principal balance faster, consumers can save thousands of dollars in interest over the life of their debt. Another approach involves taking advantage of balance transfer offers. For instance, a card offering 0% APR for an introductory period can provide relief from high interest, allowing consumers to focus on paying down the principal. Ted Rossman, a senior industry analyst at Bankrate, recommends you could pay about $300 per month and knock out the average credit card balance in 21 months without owing any interest if a suitable balance transfer is secured. Automating savings is equally crucial. Setting up a direct deposit into a dedicated savings account can help build an emergency fund. According to Bankrate's annual survey, 1/3 of Americans now have more credit card debt than emergency savings. Creating a buffer that covers at least 3 to 6 months of expenses can prevent the need to rely on credit during unexpected events. Professional credit counseling is another viable option for those overwhelmed by debt. Organizations like Money Management International offer guidance and help develop structured debt management plans. Kate Bolger, Vice President of Business Development at MMI, has noted that millennials, who now make up 43% of their client base, often seek help due to increased credit card debt driven by the high cost of living. Regulatory changes could also play a role in reshaping the credit landscape. As mentioned earlier, Senators Josh Hawley and Bernie Sanders are pushing for a cap on credit card interest rates at 10% for 5 years. Sanders has denounced the current rates by saying, when large financial institutions charge over 25% interest on credit cards, they are not engaged in the business of making credit available. They are engaged in extortion and loan sharking. We cannot continue to allow big banks to make huge profits ripping off the American people. Such measures, if implemented, could force banks to reconsider their lending practices and reduce the financial burden on consumers. The benefits of smarter credit usage extend beyond individual households. A reduction in consumer debt could have broader economic implications, potentially leading to increased consumer spending on essentials rather than interest payments and creating a healthier overall financial ecosystem. Other countries have set examples by promoting debit-based payment systems. For instance, Scandinavian countries have shifted towards mobile payments linked directly to bank accounts, significantly reducing the reliance on credit and the associated risks. The choice to use credit wisely is a personal one, but it also reflects a larger societal decision. When consumers demand better terms, more transparency, and realistic rewards, banks are forced to adjust.
I had a feeling you want to earn 3% cash back on dessert.
This dynamic interplay between consumer behavior and corporate strategy has potential to transform the financial landscape. The ultimate resolution is clear. Credit cards can be powerful financial tools if used responsibly, but they can also become inescapable traps if mismanaged. The system is designed to benefit banks by keeping consumers in a cycle of perpetual debt. Yet, armed with knowledge and discipline, consumers can break this cycle. The path forward involves practical steps that every American can implement. Start by reviewing your credit card statements in detail. Know your interest rate, understand your spending patterns, and identify areas where you can cut back. Use balance transfer offers wisely, and always strive to pay more than the minimum to reduce your principal faster. Educating yourself about the true cost of credit is crucial. Use online tools to calculate how long it will take to pay off your balance if you only make the minimum payment, and compare that to a scenario where you pay an additional amount each month. When you see that paying only the minimum could trap you in debt for 18 years, the decision to change becomes much clearer. Building a strong emergency fund is another key element. Establish automatic transfers to a savings account dedicated solely to emergencies. Even small contributions add up over time, providing a safety net that can prevent you from turning to high-interest credit when unexpected expenses arise. Advocating for stronger consumer protections also plays a role. Stay informed about legislative proposals, such as the interest rate cap being championed by Senators Hawley and Sanders. Share this information with your community and support initiatives that push for fairer lending practices. Real change requires collective action, and when consumers demand better, the system is forced to evolve. Reflecting on the broader picture, the American credit card landscape stands at crossroads. The traditional model, which has long favored the big banks through high interest and elaborate rewards schemes, faces growing criticism and regulatory challenges. Meanwhile, alternative models from abroad and innovative fintech solutions offer a glimpse of a future where financial transactions are simpler, more transparent, and less burdened by debt. For those determined to take control of their financial destiny, the message is simple. Understand the game, use the tools at your disposal, and make informed choices. Every payment, every swipe of your credit card carries implications not only for your bank account but for your overall financial health and well-being. This isn't an abstract debate, it's a matter of everyday life. The stress of mounting debt, the anxiety of not having enough savings, and the daily pressure of making ends meet affect millions of families. Recognizing these challenges and taking proactive measures can lead to a transformative change in both personal finances and the wider economy. By choosing to use credit responsibly, by paying off balances in full, leveraging promotional offers, automating savings, and seeking professional advice when needed, contribute to a future where credit serves as a tool rather than a trap. The journey may be challenging, but every step taken toward financial literacy and disciplined spending brings you closer to freedom. Every decision matters. Every dollar saved, every extra payment made toward debt reduction, and every step toward building an emergency fund is a step away from the predatory aspects of the current credit system. As more consumers adopt these strategies, the market may gradually shift, forcing banks to offer fairer terms and more realistic rewards. In the end, reclaiming control over your credit card is about more than just personal finance. It's about shaping a future where the financial system works for everyone, not just for the institutions that profit from our spending. The power to change is in your hands. Use it wisely. Your financial journey is personal, and by taking informed steps today, you pave the way for a more secure and prosperous tomorrow.